Thanks everybody for coming. We at Fenwick are really honored to be a partner and have been with Rock Health from the very beginning. Hallie and I teamed up back in 2010, and I've known Hallie for 5 or 6 years now. And it's been a tremendous partnership for our firm, and it's given us an opportunity to get in on the ground floor with these game-changing technologies and this really incredibly burgeoning sector. So thanks for having us tonight. Anyway, as Priyanka mentioned, I'm here to really just talk about, the angel and seed financing structure process. A lot of the mechanics, if you will, about how to go about making a seed investment as an angel investor. We'll cover the principal vehicles to accomplish that, which is the convertible debt versus preferred equity round structure. We'll talk about in the convertible debt a little bit about convertible notes and how you might think about that from a structuring perspective in terms of whether you're going to have a valuation cap or not. And then finally, we'll talk a little bit about a set of preferred stock structures called the Series C preferred stock. That's we take a lot of pride here at Fenwick because we've curated that on the internet at www.seriesc.com. And we're proud to say that a number of the institutional venture investors on Sand Hill Road and throughout technology have adopted those documents as a de facto standard, or at least a de facto set of forms to start from. So as a result of that, we're really able to reduce transaction costs for the companies taking in seed investment money through that vehicle. So I think Michelle touched on a few of these topics earlier about the change in the angel and seed round financing environment. A lot of the companies that are approaching Series A investors historically needed a bit of money just to get to that first value creation step. They were looking for the $500,000 to maybe a couple or $3 million of seed investment to get them to that point where a traditional institutional venture investor like an Interwest or a Kleiner Perkins would then have a much better picture of the potential and market opportunity there. So we've put out here at Fenwick an angel and seed financing survey. Unfortunately, as you can imagine, there isn't a lot of data at this point, like you might see with more traditional venture rounds that are much larger and that are either publicized or for which there's just a more robust tracking system in place through the various third-party sources. But we at Fenwick have started to collect that data, and a handful of my partners are working on that. So I find that to be a helpful survey and a data point to give you some of the sense around some of the key terms we'll talk about today. So let's talk about convertible notes or Series C preferred stock. There are really three traditional investment vehicle ways in which to bring in a seed investment. There's a fourth way that I won't get into now that a couple of the law firms in the Silicon Valley are trying to push forward, but it hasn't gained a lot of traction, so I won't spend a lot of time on that. The traditional way to think about it is either it's a convertible note structure or a preferred stock structure where it's a price-based equity round. On the convertible note structure, you've got both uncapped convertible notes and you've got capped convertible notes. And then on the Series Seed round, as I said, it's an actual purchase of a preferred equity instrument, and there are certain benefits to that. So let's walk through the convertible note structure just at a high level, and we'll dive into some of the details in later parts of this presentation. But the pros of this is, especially if you go down the uncapped convertible note structure, the pros from an entrepreneur's perspective is that it doesn't require the entrepreneur and the investor to enter into a negotiation around a valuation for the company. It allows you to just quickly take money in and put it in a structure that will have those investment dollars convert at the time of the Series A in most likelihood. And the reason I say at the time of the Series A in most likelihood is the trigger upon which those notes will automatically convert turns on a dollar threshold amount. And again, we'll get into that in a bit. The cons, of course, of this is there's valuation uncertainty for the angel investor. We don't know necessarily exactly how much percentage equity-wise the angel investor will own in the startup if you go down the convertible note structure, especially in the case of the uncapped convertible note. The concept is you will receive potentially a discount to reflect the risk that you're taking for investing in that enterprise. And if the entrepreneur is able to take the company and gain a $10 million pre-money valuation from an institutional venture fund, then the reward, if you will, to the angel investor is you get a discount of 20 or 10, 20, or 30%. So for example, if the Series A price per share is $1, then, and you have a 20% discount, then your notes will convert in at 80 cents, which effectively means that for every dollar invested, you'll have 1.25 of Series A stock. And so I think, it does lead to that uncertainty as the investor as to how much of the company you own. Now, if you go down the capped convertible note structure where you negotiate a pre-money valuation cap, you'll at least have some sense that in the worst scenario, you will own a percentage of the company reflected by that pre-money valuation cap. Again, we'll get into some of that in a bit. On the flip side, on the sort of the third vehicle that I've seen used commonly is actually doing a price-based equity round. In other words, investing directly into a company at a set pre-money valuation for a set investment amount, and that investment amount, of course, will reflect a percentage ownership in the company in the form of the Series C preferred stock you'd receive. So as noted here in the slides, there's a clear definition around the rights. There's more stability, at least from the perspective of the investor, because she, he, or it knows exactly how much of the company they own for the investment they've put in. And as noted here, because you're receiving the equity right out of the gate, there's some long-term capital gains tax treatment benefit. I will note on the convertible note structure that if the notes convert, the tax attorneys tell me that you'll be able to tack back the holding period for long-term capital gains. So if those notes convert into Series A stock, then you will be able to tack back to the original date of issuance of those notes. So that, under both scenarios, I think you do have that benefit. The Series C, because these documents have been open source and curated by us, and many of the institutional venture investors are using them, including many of the professional angels out there, I think there has been a move toward really standardizing that process and therefore reducing transaction costs. We'll talk about largely why you'd use one of these structures in a minute, but I think the goal here is to efficiently put into the company that $500,000 to $2 to $3 million investment to let them get into that first R&D mode and get to that first value creation step that will hopefully result in a professional institutional VC making a Series A investment. The cons, of course, as noted here from the entrepreneur's perspective, is oftentimes, as you guys will encounter, the entrepreneurs are really a few key team members and maybe a PowerPoint, a vision, and a dream. And it's hard to put a valuation around that. And I think that the founder sometimes finds himself or herself leaving value on the table because there is a lot of risk at that stage. So that's one of the cons from the entrepreneur's perspective. And at this stage, as angel investors, my guidance to you, and I think you heard this from Michelle earlier and from Bob and Ash last time, I think you want to be seen as pro-entrepreneur at this stage, because if the company is successful and it gets to later Series C's and B's and D rounds, your investment is going to look more like a founder investment than it will like a traditional Series C or D investment. So let's talk about convertible promissory notes, and I'm going to just sort of talk about some of the key terms. But I think before diving into that, it's probably worth sort of giving you my anecdotal experience as to why you might choose one or the other to sort of set the framework for some of these terms. So historically, as you've looked at it, and based on the trends we saw in the 2011 seed survey that we put out, I think if you're seeing an investment of sub $1 million, I think it's more cost effective, and it's probably on balance fairer to both sides to go ahead and just use a convertible note structure. It's easier, it's more cost efficient, there's fewer documents, and it's just a simpler vehicle. If you're raising something like $1.5 million, $2 or $3 million, at that point then it becomes the transaction costs associated with going down a full-blown Series Seed investment may make sense, and it's probably more fair because that's a sizable investment amount going into the company, and having some certainty around the terms, around the equity ownership percentage interest that you're receiving as an investor probably is the fairer outcome. But I've seen deals done across all those three vehicles, the uncapped note, the capped note, and the Series Seed price-based equity round structure, and it really is at some level of negotiation. But at this stage, as angel investors, I would encourage you to think about making it as simple as possible, reducing transaction costs for the company, because they're going to be taking your dollars and having to pay lawyers to actually document those negotiated deal terms. So the simpler you can do it and the more cost effective you can do it, the better for everybody, because those dollars can then be used for R&D, development, team building, et cetera. So let's talk about the convertible promissory note structure. So again, there are two different alternative structures. There's the uncapped note that I talked about earlier and the cap note. I think it's really a question of negotiation leverage, I think at some level, in terms of which structure is ultimately chosen. But I think now, with the pendulum having swung in my experience in the last 6 to 9 months in favor of investors, in other words, investors, because there are more limited dollars, because there is still a lot of economic uncertainty in the general macro climate, I think we are seeing that capped convertible notes are where we're seeing most of my seed investments, in that sort of sub-$1 million range. And the cap, the pre-money valuation cap, is something we'll talk about. But let me go through some of these key terms. So, when you look at a convertible promissory note, the typical approach would be to prepare a one-page term sheet that will lay out what are the total amount of funds to be raised here. It's up to $1 million in my hypothetical that I started with earlier. What's the interest rate? Well, I'm seeing interest rates all over the map, but generally I'm seeing anywhere from 4 to 8%, with that 5 to 6% interest rate being typical. Let's face it, you're not investing in these companies for the hope of a 5 or 6% annual return. And if you are, this isn't the business you should be in. So the interest rate point, when entrepreneurs, and when I advise them and they get hung up on that, it really is immaterial, especially on the dollars involved in the time frame we're talking about. Term and maturity, a key question, because this is really designed to be an accelerator to that next value creation step, so that an institutional VC will take an interest and say, you know what, I'm prepared now to make a $4, $5, $6, $7, $8 million investment in a Series A. And so I would typically see these days anywhere from 12 to 24 months, with 12 to 18 months being sort of where I think the bulge bracket of the deals I'm seeing ending up. That's a good exercise as well for the entrepreneur, because it forces the team to work hard and work fast, because they don't want these notes to reach maturity. They want these notes to convert. And the idea is to put a fuse there, and I think the term of maturity is one way to do that. The next point here is qualified financing. This is what I referred to earlier. The question is, when does the note automatically convert? And that turns on how you define a qualified financing. In most of the term sheets I see, you're going to see that number be somewhere in the $2 to $3 million range. In other words, when the entrepreneur goes out and identifies an investor, and that investor is prepared to put in $3 million in a Series A, those notes should automatically convert into that round. There are questions about whether the $3 million threshold in the hypothetical I just mentioned includes or doesn't include the actual notes that are converting. And so you need to think about it. Am I looking for that threshold to be tied to new money coming in, fresh money coming in that Series A, or am I comfortable recognizing that we raised $500,000 in the seed convertible note structure, and now I'm raising, and the threshold is $2 million, for example, and it includes the notes, and that means you're really only bringing in $1.5 million of new fresh money to trigger that auto convert. Let's talk about the economics, and I've alluded to a number of these already, but let's just walk through it. So the typical structure, again, is to provide a discount, to reward you for the risk you've taken by giving you anywhere from a 10 to 30% discount is where I'm seeing the vast majority of deals. I think that I'm seeing most around 20%. So again, in that hypothetical I raised earlier, a Series A investment at $1 per share means that you will convert at 80 cents, which means that you'll have a 1.25 purchasing power for every dollar invested. The valuation cap comes into play, of course, if we end up in a capped convertible note structure. And the way that would work is that the notes would convert if there's a qualified financing at the lower of either that 10 to 30% discount in the uncapped structure, but also the lower of, or that pre-money valuation cap that you negotiated. So where I'm seeing those valuation caps really, as you'll see from our survey, span quite a bit, but I think you're seeing it anywhere from the low millions, 3, 4 million, to as high as 7, 8, 10 million, is where I'm seeing a lot of the deals. And again, it's a function of leverage. It's a function of how how experienced the team is, and all the variables that Michelle at InterWest previously reviewed with us. So the benefit to you as the investor, of course, is, again, you have certainty that that $1 million you invested as an aggregate angel group will convert at no worse than an $8 million pre-money cap, even if the entrepreneur and the company are able to go out and get a $10 million pre-money valuation from an institutional investor. That money will come in at that higher valuation, but the notes will convert at that lower cap. Warrants, something that we used to see a lot more in Silicon Valley, certainly several years ago, where instead of maybe a discount, we would get warrant coverage. So for every dollar in the convertible note you invested, you'd get 10 to 30% of warrants into that Series A round. I'm not a tax lawyer, but I'm told by the tax experts that there are some imputed interest concerns associated with issuing warrants to investors, and so they've become less in vogue, and I think we're seeing them less often, though we still see them occasionally. Another key term is what happens on a change of control. As we talked about earlier, you're not investing in this for the hope of getting a 5 to 6% interest return over a 12 to 18 or 24-month period. So the question is, what happens if the company is acquired before they raise a Series A? And it's happened a handful of times to me in the last 3 or 4 years where Google approached a startup and said, you know what, I really want the team. Facebook's doing this, and other late stage and early public companies are looking for what are called these acqui-hires. And so they're out there buying these companies, and they may approach a company and potentially pay for that company before it even raises Series A. And under some structures of these convertible notes, you're sort of stuck saying, well, all I get is my money back. Well, one key term to think about is whether there should be a premium placed on the money in the event a change of control occurs prior to the Series A investment round. And I'm seeing that fairly typical because from an entrepreneur's perspective, it's a small give. The likelihood of that happening is fairly small, but giving a 25, 50%, even 100% return, if that 1 in a million situation or 1 in 1,000 situation occurs, and the company is actually purchased before the Series A happens. So think about whether there's a premium that you should try to negotiate as part of the change of control situation if that change of control occurs prior to the qualified financing, that Series A financing that I keep referring to. Another term to think about that I see often, though it's certainly not a majority position, is whether there's a right to convert at agreed upon valuation. In other words, maybe there's an M&A coming down, that acquisition, the Series A hasn't happened, and you say, well, I'd rather participate in that round, and so I'm going to go ahead and negotiate the right to convert my note into common stock. And typically it's done if it's a cap note at that pre-money valuation cap that was negotiated. So instead of waiting for it to convert to that Series A round, an acquisition offer has come on the table, and now you say, I'm going to go ahead and I'm going to exercise my right to convert into common stock at that pre-money valuation cap. Again, from the entrepreneur's perspective, as I advise them, it's probably a fair outcome, and frankly, because the likelihood of it is so low, I think it's not a big give on the part of the entrepreneur. Just one lawyer's opinion. Then there's, then of course there's many convertible notes out there where there's no premium. There's nothing, because the likelihood of a change of control, if a founder pushes back on that aspect by you as angel investors, because the likelihood is so low, on the flip side, it's an easy give for you too. It really isn't that critical. And frankly, it may be something you decide there isn't going to be any benefit. If in 12 months they get bought, I get a 6% return. In this market, at interest rates where they're at today, that isn't so bad. So then another key term you see, and this is one that's probably one you ought to take a look out for, because you probably, if you're looking to do truly seed investing and you're looking at doing $25,000 or $100,000 investment, as I said earlier, one of the key terms is the amount to be raised, and the question is, so if it's up to $1 million and you invest $100,000, if there's a majority and interest provision in there, other note holders can get together and amend the terms around you. Now, that's probably a fair outcome, to be honest, but it's one that you ought to think about, because you don't, on the flip side, as the company, want to be held to negotiate with just one note holder if the overwhelming majority of the principal balance of those notes says, hey, we're okay with amending this term. So like everything else, under Delaware law, under California law, majority rules, and I think that's a provision you ought to look for and think about and evaluate whether it makes sense in your particular situation. I put here a little others section to think about whether there should be, a no prepayment clause. I mean, if the company is successful, as Michelle alluded to earlier, and is able to get that seed investment and start generating a profitable business, they may say, you know what, I'm just going to prepay these notes now. I'm going to pay off, get them off the books, never take the dilution, and move on. And that may be the right outcome in that particular context, but it's something you ought to think about. And I see in the majority of cases that I look at that there is a no prepayment clause. In other words, that the company can't prepay those notes without the consent of usually a majority in interest of the note holders. So how do we actually implement this structure? What's the process? Well, here's the beauty of the convertible note structure. It's really just two main documents. It's an overarching note purchase agreement that lays out the key structural considerations. It'll have representations and warranties made by the company that the company is in good standing. It may even represent and warrant about matters about approvals and other sort of standard clauses. And then there'll be a set of representations and warranties that the investors will make to ensure that the company has a valid basis to issue the security to the investor. In other words, we don't, as a general principle, want investors who are not accredited investors. Under the securities laws, accredited investors are, for purposes of this group, largely defined as anyone who has made $200,000 in each of the last 2 years and has a reasonable expectation of making $200,000 in this coming year, or those same scenarios at $300,000 with your spouse. Another key trigger is whether you have $1 million in net worth, excluding, recently a change in the law said, excluding the value of your primary residence. In California, there are a lot of people that qualified as accredited investors simply by the home that they lived in. And the SEC and Congress decided to exclude that explicitly. So at any rate, the representations and warranties will go to whether you're an accredited investor or not. So that overarching document, that note purchase agreement, will lay out the broad structure. Then underneath that umbrella document will be notes, promissory notes that will be issued. And those notes, again, will be either uncapped notes, depending on what you negotiated, or capped notes. And those economics will largely be laid out in those individual notes. So this structure is a very efficient way for the company to say the note purchase agreement allows the company to sell up to $1 million of notes, and each note would be documented to represent that $25,000, $50,000, $100,000, $250,000 investment amount that you'll be making as an angel investor. Okay, so I think I've laid out some of the key terms, and there are so many other nuances, and when we get to the Q&A section, happy to chat about it, because there are certainly many, many other nuances associated and variations and variables on that core sort of structure. Let's talk about a Series Seed round. So before Series Seed became a common vehicle, many early stage companies were forced with choosing to either do a full-blown Series A preferred stock financing or go down the more streamlined convertible note structure. It became clear that there was a need for another vehicle, one that was sort of, for lack of a better phrase, a Series A light. And so I take a lot of pride in saying that my partners at Fenwick really have pushed and have focused the industry on this Series Seed preferred structure. So a typical Series A structure has 5 key documents, 5 main documents. A Series Seed preferred structure, as you'll see on that website that I referenced earlier, only has 3 main documents. So already you're giving the lawyers 2 fewer documents to negotiate and fight over. So that reduces transaction costs significantly. But at any rate, there are a lot of rights and terms that just didn't make sense for an early stage company. So for example, in the Certificate of Incorporation, which is the governing constitutional charter of the company, there's no preferential dividends. The notion that an early stage company taking $1.5 million, $2 million, $3 million is going to even contemplate dividends is just nonsensical. So why include a whole clause and a whole section in the Certificate of Incorporation to deal with it? So the Series Seed, as part of that Series A light structure, took that concept out. There are no redemption rights. You know, the notion, again, that as a seed, early stage investor, you're looking to have your stock redeemed at some point in the future. That's not why you're investing. You're not looking for a set return like a traditional mature public company might provide to investors. Instead, You're looking for, hopefully, that huge exit. That's that $50 to $100 million a year annual run rate revenue company that exits its, several $100 million or more. There's no price-based anti-dilution in the Series C documents. In other words, your typical Series A structure will have a provision that says that if you issue securities at less than this price, you're going to adjust the conversion price of that Series A so that if and when it converts to common, it'll convert it more than 1-to-1. That concept just doesn't have a lot of bearing in the Series C context, because at this point you're really trying to get to that first value creation step, and if you don't, the reality is you're not likely to do another round. You're likely to probably either try to sell for a basic price, or unfortunately, as some companies do, they dissolve and shut down. So what's the structure here beyond the certificate of incorporation? Well, the stock purchase agreement is slimmed down. We don't have the 10 pages of representations and warranties that a company would typically give in a Series A financing. Instead, you'll see a slimmed down version of 2 to 3 or 4 pages, I believe. And the reps are really focused on making the company assert and represent to the investors the key things that you care about: the capitalization structure, the intellectual property rights, sort of the very fundamental reps that are core to your investment decision given the amount of capital at risk here. Another big feature here to slim down the documents from that Series A set of documents is there are no closing conditions. Practically speaking, you're not going to invest and sign those documents until everything is set and ready to go. In other words, the signing of the documents and the closing of the transaction will in all likelihood occur at the very same point in time. Metaphysically speaking, the signing of the documents will occur at point 1, and then a millisecond later the funding occurs. So there's just no need to go through this whole notion of putting together all of these closing conditions. It just doesn't make sense, especially once again, it's just more paper, more documentation, and therefore increased transaction costs. Probably the biggest benefit from a transaction cost perspective is the one reference there, which is the legal opinion. A legal opinion is a document that law firms are asked to provide to the investors, opining to various fundamentals about the business, typically around the authorization of the transaction. There will be some confirmation of the capitalization of the company, and that exercise is a detailed one for the law firm. Essentially, it's providing, for lack of a better phrase, an insurance policy to the investors. And again, requiring the company's counsel to go through that exercise for the dollar amounts involved here just doesn't justify the cost and effort. And so I think many of the institutional venture firms on Sand Hill Road that are using these documents have learned to live with that, and I think everyone's comfortable. Because again, if the company isn't able to get to that value creation step and get to that Series A financing, it doesn't really matter whether you have a legal opinion or not. Another thing you'll see here is there is a slimmed down investor rights agreement. In a typical Series A financing, you'll see registration rights. Rights around if and when the company goes public, what rights do I have as an investor? At this stage, an early stage investment, we're not talking about going public. We're trying to get to a Series A. So the notion of 6 pages of registration rights and when can we demand certain registrations, when can we tag along with the company doing an IPO, I mean, that's interesting reading, but it's really not applicable to the 99.99% of the seed stage companies at that particular juncture in its life cycle. You won't see a lot of the covenants and rights that you might see in a more traditional Series A structure, but you will see a very important right in there, and that right's the one alluded to in the next bullet point. The Series C investors should get whatever rights the next round investors get. And if you go to that SeriesC.com website and pull down that form term sheet, you'll see that one of the covenants, both in the term sheet and in the investor rights agreement, is exactly that covenant that you will be provided substantially similar rights to the Series A. So while you're giving up some of those rights now, the idea is if you get to that Series A, you will get the opportunity to incorporate those additional bells and whistles that have been stripped out and slimmed down at that Series A point. I also just added a couple of other things I see. The company, sometimes you'll see that the company should have, if the company was incorporated by a traditional sort of technology law firm like Fenwick West, they will have a right of first refusal over transfers of shares. So when a founder receives her or his shares, or when an optionee in the company exercises her or his options and receives stock, if they are subsequently inclined to try to sell those shares on some of the secondary markets that we've seen a lot talked about recently in the press over the last year, the company has a right of first refusal typically, or should. And that's something that I think most institutional venture investors would expect and frankly demand as part of any investment they're going to make if it's not already there. But it's certainly standard protocol. And so one of the covenants you might see in a Series Seed round is that the company agrees to assign that right of first refusal over those shares to the major investors in the seed round. So the company obviously doesn't typically have the working capital that it will deploy to buy stock. So an employee quits or is terminated, has some vested stock, decides to go out on one of the secondary market trading platforms, offers to sell her or his shares at X dollars per share or X cents per share. The company then, if it had a covenant like this baked into the investor rights agreement, would have the obligation to assign that over to the angel investors or the seed investors to see if they wanted to exercise that right and acquire that stock. Sometimes you see that in there. I referenced here a convenience drag. A drag-along clause is a clause you'll see oftentimes if the company is approached to do an acquisition, and if certain triggers are met, including typical triggers being approval by the board of directors for that acquisition, approval by oftentimes a majority of the common holders, and approval by a majority of the Series Seed investors, then the other investors who aren't part of that majority are dragged along to vote in favor of that transaction so that there aren't any dissenters in the transaction. So you oftentimes see that, and we call that colloquially a convenience drag-along right. So I think we've laid out some of the key sort of terms. As you think about the investment structure, I think it's helpful to sort of say to yourself, how much is being raised in this round? Who else is going to participate? How quickly does the company need or want the round to close? I think all of those considerations go into whether I'm going to do a convertible note or I'm going to do a price-based equity round. Then you're going to look and say, well, given the dollars that are proposed to be invested and given the transaction costs associated with that, what's the most efficient way to do this? And I think I'll leave you with this final thought from an entrepreneur's perspective, and therefore from ultimately your perspective, because as I said earlier, if the company does this right, the seed investors are ultimately going to be more like the founders in terms of their incentives than they will be like the Series C or D investors coming in at $50, $60, $100 million pre-money valuations. And so, don't sweat the small stuff, as they say, and focus on the big economic points. And if the company is represented by a traditional law firm, a reputable law firm, I wouldn't fight the legal terms too much. Anyway, that's sort of how I think about seed structuring and investing, and happy to take any questions.